So what is the next theme that you would be looking at to prepare for potential carnage or potential upside?
All right. Well, if you see, we've been through carnage, and the period in history that rhymes the most with the current period, I think, is the late 1970s to the early 1980s. We'd already had to deal with inflation.
Pre-morning in America.
The morning in America came in 1982, in August of 1982, just as Three's Company was getting bad. But in any case, a man named Paul Volcker was the Federal Reserve Chairman. He raised interest rates like Jerome Powell, the current Fed Chairman, is doing. He raised it. They were already high. He went from 10% to over 22% for the federal funds rate. By comparison, we're now in the 4.25 to 4.5 range. But in terms of the urgency and the magnitude of the rate hikes, we're in a very similar period from 1979 to 1982. During that period of time, we had 2 recessions, and Volcker just drove that truck into the recessions until they said, they had to pull him off. Like,
right.
Hey. Then he went back at it, another recession, and then nobody believed inflation would come back again, and it worked. 1982 to 2000, we had a monstrous bull market that ended in a little bit of tragedy.
Well, let me ask you, because when you mentioned Volcker, it does sort of raise the fact that we have been in an abnormal period of interest rates for the past, several years. So are we not just returning to normal? I know you're talking about the specter of how quickly this is happening, but, money has been, in essence, free. And can we basically say that is not likely to come back again in any meaningful sense?
I don't think over the long term that you could be paid to borrow money. It just doesn't usually work that way. But we had that strange negative real interest rate and sometimes even negative nominal rates over in Europe. But yes, we are coming off of a period. Since 1981, interest rates have done nothing but go down. The 10-year Treasury yield, which is high now at 3.7%, was 16.5% in August of 1981. So we are getting back to, and the average over the past century or so is about 7%.
So it sounds like there are perils for bond investors in this market, right? Is that something that is an issue that you think?
Well, you can talk about perils over the past year. Look at, if you had long-term Treasury bonds, you're down about 15 to 20%. You had no safety from the stock. People traditionally buy bonds and they think, oh, the stocks are a little too risky for me. I better be in the bond market. Bond market has been a horrible place. At some point, when the Fed does decide to stop raising interest rates and maybe even start cutting them, rates go down. And when rates go down, the value of bonds goes up. I know most people aren't, big bond players, so they're not going to be. Most people don't even buy bonds anytime in their lifetime.
$10,000 inflation bond, right? Isn't that
those were the big deals in the past over the summer when they were offered? The I bonds were 9.62%. They're down to about 7.1. They're pegged to the CPI increase. So my overall counsel for anybody who is looking to throw some money into the market or protect what they have is to choose sensible stocks that have been around, companies that have been around for a long time, have track records of always rewarding shareholders. They're in businesses that aren't, it's not in a state of long-term decay. So you want to see earnings growth. You want to see profit growth. You want a dividend yield that is going to compensate you for holding those stocks for potentially 4 to 7 years. Let's not forget that's the advice that people usually get is, hey,
diversify.
If you don't need money for 4 to 7 years, stocks are in a great place. If you need it for your gas bill, you need to be, in a checking account.